Hello and welcome to the fourth edition of our Investment Insight series, Magellan Minutes. Unfortunately, due to COVID, we found ourselves broadcasting via Zoom yet again. These challenging times continue, but we are hopeful that we'll be back in the studio again very soon. My name is Jennifer Herbert, Key Cap Manager at Magellan, and in this session, I'll be talking with Pullen, Head of Financials and Portfolio Manager. We'll be discussing the recent strength in the financial sector, why Intercontinental Exchange has gone from strength to strength, and whether inflation will affect the cryptocurrency trend. Thanks for joining us, Al.
A pleasure, Jen.
Al, the financial sector had a very strong 2021 with the sector up over 30% on the year. Which parts of the sector outperformed and which parts underperformed?
Thanks, Jen. It had a very good year last year, the financials. They tend to be economically quite sensitive stocks in that sector. And what we saw last year, obviously, was a rebound in economic activity following a very weak year, obviously in 2020, with the pandemic first hitting. So we actually saw a good rebound in economic activity. That was driven a lot by government stimulus and payments, as well as people getting back to work. And that resulted in the household sector being really, really strong last year in terms of their spending and in terms of their household finances. So that benefited financials significantly. Most part of the financial system benefited. Payments were a little bit weaker on cross-border, lagging a little bit. And I think you're going to talk to our payments expert on that in a bit more detail. But across the rest of the sector, we saw strength in insurers, credit rating agencies, exchanges, and of course, banks had a very good year. In particular, banks had record low credit costs. Just with those strong household finances I was talking about, nobody was missing payments on their loans. So they had record low credit costs, which is incredible when you think just how disruptive we thought the pandemic was going to be just 2 years ago. Results were strong, and that's been reflected in the strength in their share prices over the past year.
So as you highlighted, the traditional banks, while coming off a low base, have done very well. Is there still further upside in the banks? And if so, is it an opportunity that we're looking at?
Well, Jen, a lot is in the price now, but they are economically sensitive. So if the economy continues to do quite well going forward, there could be a reasonable year ahead. One thing in their favour is the potential for higher interest rates. Higher interest rates do benefit their net interest income, so that could be a tailwind to the sector. Having said that, the problem is that if we get central banks finding themselves behind the curve on inflation, and we just had a 7% inflation print in the US, they may have to raise rates faster than people expect, and that could actually have a negative impact on economic activity. And as we were just saying, record low credit costs last year could start to normalize faster than people expect. And that would be a real headwind to the sector. So we're monitoring for opportunities, but the risk reward at current prices just doesn't seem attractive. And when we look further ahead, of course, there still continues to be challenges from decentralized finance and technology companies potentially impacting and other fintechs potentially impacting the sector going forward.
Intercontinental Exchange, or ICE, is now a significant holding in our portfolio and, pleasingly, it's had a very strong last quarter. What can the recent share price strength be attributed to, and do we still see further upside?
Yeah, thanks, Jen. The exchanges have had a good year last year, and ICE in particular did really well in last quarter. Now, they have significant exposure to energy markets. They host many energy contracts on the derivatives exchanges, which people use for risk management and speculation in that market. Of course, we saw some significant volatility in energy towards the end of last year, so that really benefited their volumes. So the share price performance was really just reflecting the strong underlying earnings of the company. We're also pretty pleased with development in their environmental complex. So they're a leading exchange for managing carbon risks and trading carbon credits, for example. And they're also are highly exposed to natural gas, which is an important transition fuel as we move towards a carbonless economy. And we saw really good growth in kind of that environmentally friendly part of their markets as well, which was super encouraging looking forward. The other thing that we got towards the end of last year was real strength in that mortgage technology business. Now, this is one of the real reasons we like the company. We think that's a growing area as they digitize that mortgage process in the US. And we saw adoption of their digital products really accelerate towards the end of last year, notwithstanding an actual slowdown in the refinance market in the US as rates started to move up. We were concerned about the slowdown in refinancing having some impact, but the structural growth that they're getting from that digitalization and bringing new clients on is offsetting that at the moment. And that was really pleasing to see. So the share price performance is really just reflecting the strength in the underlying operations of the company. It still trades on what we think is a very reasonable PE of around 26 times forward earnings. And we expect, with its capital light model, that to generate about a 4% free cash flow yield, and that's growing at about 10% a year. So that's still a really compelling opportunity for investors.
Actually, Al, last time we spoke, you enlightened us all on decentralized finance, which is, as you explained, is a financial system that doesn't rely on intermediaries such as exchanges or banks, but instead uses smart contracts on a blockchain. Do you see this as being a threat to ICE?
Yeah, good question. And the kids are calling it DeFi at the moment. It's a cool way to say it, Jen. But it's very early days, obviously. DeFi, as you said, takes out central counterparties from the financial system and kind of aims to replicate what they do using the blockchain. It's very early days. Adoption is going to be threatened by, potential regulation and technology issues. But I think there is an opportunity here for where what the centralized counterparty really does is just facilitate the transaction, what we call clearing and settlement, kind of in financial markets. And if all you're doing is clearing and settlement, and that can be done more efficiently on a blockchain, then that's certainly, ripe for disruption going forward. Having said that, most centralized counterparties, participants in the financial system today, offer more than that pure clearing and settlement kind of process. And in particular, when we're talking about ICE, they do clearing and settlement for all their derivatives contracts and stock exchange contracts. But that's not really the core function of what that clearinghouse does. It's actually a risk management operation. When you when you take a derivatives contract, you have an open position, and that is marked to market daily, and you have to post collateral or can take collateral out. And it's you want to concentrate all that in a centralized exchange because it's way more efficient to do it that way, and you have to post less collateral if you've got multiple contracts in a central exchange. So it's much more a risk management operation than purely kind of a clearing and settlement procedure. So we see pretty minimal risk from DeFi for ICE.
Finally, if we do see inflation and a subsequent rise in interest rates, do you think we'll see investors less enamored with cryptocurrencies and perhaps even returning to old school banking practices?
Well, that's a tough question. I think, most people aren't using typical cryptocurrencies, take Bitcoin, for traditional banking kind of products, think payments or as a store of value. But they certainly are using it kind of as a speculative asset. And it really is a speculative. It doesn't have any cash flow. You can't value it on traditional valuation means. It's kind of a purely a speculative investment. And of course, the cost of that has been pretty low, because when you think what people might have been investing in previously, say a term deposit, they're really not earning much on that, if anything at all, at the moment. So as interest rates do go up, you could certainly see people starting to earn a bit more money on term deposits or other kind of traditional financial products, and perhaps that does put some pressure on cryptocurrencies such as Bitcoin. It's hard to say. Obviously, you can't value the asset on cash flows or anything, but it certainly could be a headwind going forward.
Al, thank you so much for sharing your insights with us today.
No problem at all, Jen. A pleasure.
And thank you to everyone for watching. If you have any questions, please don't hesitate to reach out to the Magellan distribution team, and do feel free to share this update with clients or colleagues as you see fit. Take care and stay safe.